On and talk about complex chemical sector, especially the ones which are doing high quality business, and one such company is Epigral Limited. Maulik Patel is joining us. Maulik, first of all, Anisha and I were just discussing the thinking behind changing the name and what exactly does it capture. How will it reflect in your fundamentals over the say few quarters or maybe a year or two ahead?
Yeah. So name change we have done because in the past, if you see our history since we started our production in 2009, we are in the chloroalkali business, which is considered as a bulk chemicals. And last 5 years, we have changed our strategy from bulk chemicals to value-added chemistry and the multi-product chemistry, which is coming out from the chloroalkali. So because of that, right now, if you see last year, our 70% revenue coming from the caustic soda chloroalkali and 30% is coming from the value-added chemistry, which is multi-product. And now we are next 3 years, our focus is completely on the multi-product, and we are doing a capex also in the multi-product side, value-added chemistry side. So we thought it is the right time, and in quarter on quarter, our volume is going to increase as well as the revenue will increase from bulk chemicals to the specialty chemical side. So we think it is the right time to change the entire company rebranding itself. And that's why we have done the name change from Make Money Fine Chem Limited to Epigral Limited.
You gave us a lot of points to talk about, the capacity expansion that you're doing, the volume recovery you're talking about. To talk to me about the volumes first up, you'd earlier hinted that there will be a recovery from Q3. Is that panning out? And when you say that volumes will inch up substantially, what could be, let's say, the annual run rate versus the historic average?
See, there is volume increase because of the two major reasons in our company. Because one is definitely the market from the quarter one. It is month on month. It is is coming better and better. And quarter three onwards, we find it. Most of the companies, chemical companies, will run on the optimum capacity, which is 80% normally. And second thing, we are continuously last 3 years we are doing a capex in the value-added chemistry, and because of that, last year we have commissioned two major plants. One is epichlorohydrin, another is CPVC resin. Both the molecules are import substitute, and because of that, now our customer Apollo has achieved in both the product, and we are increasing month on month the volume of both the products.
Maulik, so I was just looking at the data point that complex chemistry is now 70% of your overall business versus say, or maybe actually in a year's time will become closer to 70%, in the 30% right now. How does your average margin trajectory, last 5-year average versus next 5-year average, how is that likely to change because you move into a different trajectory now?
So last 5 years, 70% is coming from the chloroalkali, which has multiple events in last 5 years. One of the European technology was down. In the major technology from the chloroalkali industries was down, and because of that, there was a vacuum globally. Second thing, last 2 years, because of the Ukraine, the energy price has gone up. Because of that, energy is considered as a major part of chloroalkali manufacturing, and because of that, the price has increased so much. So because of these two reasons, I think last 5 years, I think we have enjoyed 25% to 30% margin in the chloroalkali itself. But going forward, we believe that we are increasing the capacity also in the chloroalkali. We thought it is, if you want to run your plant optimum capacity, then you need to have a value-added chemistry and captive consumption of the chlorine, which is coming out as a co-product from the chloroalkali industry. So that's why we are adding capex in this, and we believe that going forward also our margin will remain on a longer term basis. In the second half of this year, definitely it will be around 20%, 25% EBITDA margin we are expecting from our entire complex.
Okay, so that's a margin expectation on a consolidated basis for the next few years. But what about revenue? When do you see yourself hitting that mark of maybe 5,000 crore on the top line?
So 2027 we have forecasted that because continuously we are adding a capex 350 to around 350 CR every year, and we are adding new chemistry and import substitute molecules. So we thought that our volume and as well as the value we will target to reach around close to 5,000 crore by 2027.
Okay, and just before I let you go, we have heard a lot of news flow over the last 2 weeks about how the prices of a lot of chemicals and specialty chemicals has been moving on account of the China angle. Could you give us the update in terms of your raw material as well as the final products, how the prices are moving?
Yeah, globally, the China is the biggest manufacturing hub for the chemical. At least I would say, most of the 50% of the chemicals are manufactured in China. But China itself has a local consumption because their economy is also doing great and they are continuously spending on the infrastructure and so their local consumption is also increasing. So I think last couple of quarters, I think their local consumption was down and their economy was not doing great, and that's why there is a pressure overall in the chemical industry globally. But I think they've done the changes in the local policy to just increase their GDP data, and because of that, I think we are expecting the prices are improving globally right now, month on month basis, and we are expecting, I think by quarter three, I think we are going to be back on track again in the chemical industry, most of
That's
the
it.
products.
Oh yes, that was one of the points I wanted to discuss with you. The dumping of Chinese players because their own local demand was low into the international market. Are you seeing clear signs of that reversing? And overall, how are the inventory levels across the world?
Yeah, so as I mentioned, yeah, that is improving in China. Domestic angle is improving. Another factor is US and Europe. They were keeping lot of inventory. I would say 6 months to 1 year ago, they are keeping lot of inventory in the pipeline. And because of the European interest rate and the US interest rate has also gone up, so they also focus on the inventory management more. And because of that, because they also have a now interest pressure. So because of that, they have kept inventory very low. So entire pipeline is now, a vacuum right now in terms of the inventory proper planning in US and Europe. Because of that, there was a pressure in the supply chain entirely from India also in the specialty chemical sector. And I think by quarter three, I think most of the inventory which was there and which was there in the pipeline, I think it is going to be vacuum. And I think again, the production and supply chain will be start moving from quarter three onwards in the entire chemical and specialty chemical sector specifically.
Okay, point taken. On that note, Mr. Patel, we'll let you go. Thank you so much for making time and speaking with us. But from the